Welcome everyone to our session today. It's gonna be my side, the startup CFO, and José from Bankuish. And as Adrian said, we're gonna discuss about fundraising in 2024 from both our experiences. So we work with a lot of startups, and the startup CFO, and José as an entrepreneur himself. Okay, so we're gonna go through who are we a bit more in detail, wrap up from 2023 what we have seen in the main insights in the market, tendencies that we can expect for 2024, relevant KPIs that is crucial for fundraising, and best practices. Okay, so who are we? I'm Juvenal. I'm a partner and director at the startup CFO. We are partners with Insomnia and Santander for the mentorship program. We offer fractional CFO services for startups. One of them is Bankuish. We are more than 25 in 2 offices in Madrid and in Berlin. Historically, we have served more than 250 startups in more than 20 countries. You can know more about ourselves in LinkedIn, in our YouTube channel, or in Academy, that is a B2C course that we have with online sessions. Okay, and Jose, maybe you can do the introduction for Bankuish and yourself.
Of course. Thank you, Juvi. So my name is José Fernandez. I'm the CEO and founder of Bankuish. I'm originally from Madrid, Spain, and currently based in our headquarters in Miami. Bankuish is a startup that was born 4 years ago and offers better financial services to gig workers, so to Uber drivers and couriers and freelancers on Upwork or Fiverr, and even creators. Anyone that offers their services through a platform that manages their income and rating. And what we do is we offer them better banking solutions from the largest banks in Latin America by turning all of the immense amounts of data that they accumulate in their gig platform accounts and turning this data into an alternative credit score currently used by the largest banks in LATAM. We expanded our presence through the last 4 years through Mexico, Brazil, Colombia, Chile, etc. And we've raised a couple rounds. Our pre-seed was 1.4 million. Our seed was $4.6 million, and we have seen a lot when it comes to fundraising. So happy to share all the lessons learned, because everything about being a founder is grit and learning and making sure that there's going to be a lot of mistakes along the way, but let's make them new ones every time.
Yes, only one thing, guys. Just for you to know that you will be able to make questions. Try to write them all by the chat, and I will, if I can, stop both Jose and Kubi if I have the chance, and if not, we will change just only for the Santander X100 members to the other link for them to have more one-to-one approach. Okay, so just to clarify that. Thank you so much.
So, by the way, we met Bankuish and the startup CFO in a mentorship program from Santander in the last edition. This is our second one. So for you to see that it works, and you can find true insights here in these mentorship programs. Okay. So wrap up for 2023. What we have seen with the clients that we work with and with conversations with VCs is fewer rounds and smaller. Okay, it is much harder to fundraise in 2023 after 2 years of explosion in the VC ecosystem, entrepreneurship ecosystem, and startups are getting into survival mode. So it's important to save your cash, try to be as efficient as possible. Funds prefer, as of now, efficiency over growth. Those years where they were seeking extreme growth at any cost are over. Our recommendations will be try to save your cash because of what we have seen in 2023, and be conservative with timings for closing the rounds, because it takes longer than what it used to take before. We saw before average 6 months, I would say, since you start the process until you have the cash in the bank. In 2023, it went until 9 months, and especially a lot of bridge rounds. So it's not those huge rounds with new investors that we saw before, but rather small ones with current investors just to try to save the year or save some months and looking into bigger rounds in brighter future. Okay, here are just some numbers for you to identify the trend that I'm mentioning. So this is the money invested by VCs in 2023. So it decreased a lot from those years that were crazy in 2021, especially. Then it went down, but 2023 we have suffered a lot, and we have seen startups that didn't make it, and they weren't able to raise even with current investors. So it's getting harder and harder. Okay. This is just a graph about multiples you can expect. So valuations are suffering a lot, and this is one of the reasons why it is getting harder to raise funds, because you're having down rounds, or the expectations entrepreneurs have about the valuation they could get before are suffering. So VCs are quite hard on this right now, and they are offering very low multiples. So this is triggering harder negotiations and killing deals that would happen before. Okay. And finally, this is what I said about the tendency we're seeing on what VCs request from startups in saving money, being efficient, and not compromising their cash at any cost. Okay. So this is our view from the outside, I would say. Maybe Jose can give us some more insights on his experience in 2023, although it wasn't the year when Bankuish fundraised, but of course you're in constant contact with the market, and maybe also let us know a bit more about your last funding round and what was your experience there.
Yeah. So everything has changed last year. We went through 2021 and 2022 where growth, and I'm sure everyone here has experienced the same thing. Growth was everything that VCs cared about. And then you build a company that is pursuing that growth, whatever that metric means for your companies. And then suddenly the paradigm shifts, and everything you have built is not what matters most. What matters most is unit economics, it's profitability, things that you hadn't looked at before, EBITDA, things that you didn't care much about before, are the things that matter most to the investors. So I mean, I'm gonna echo mostly what you said. I'd say that on the side of the founder, there's a few things that have changed a lot in my mindset. First and foremost, do due diligence on the VCs, because these people, they do this for a job, right? They are a VC, a partner, an associate, an investor. They do this as a job. They have to keep on having the pulse on the market. So they're gonna still, send you emails and want to have calls. But they might not have money to invest, or the money they have might just be for their portfolio companies. Be very mindful of your time and do your due diligence. Crunchbase is great to be able to see what were their last investors, and if you do take a look at that, make sure that the last investments, if you see activity, you're like, oh, cool, they're active. Make sure that they weren't just, follow-ons on their portfolio companies, and they're not just, supporting their current investors. And then also the growth versus unit economics. And I think there was a question about, can you explain the axis of vision? I'm gonna let you get into that one, Kubi, but the Henning's question. But on my end, the thing that you should also care about is, if you're like me, that cares about growing your business a ton and having a very big impact, and you feel like you have a responsibility because you have something that works and helps a niche amount of people, and you think that if you scale that, you can help a lot of people with that technology, you want to grow, and now that's just not as easy. I would very much warn everyone that you need to beware of your runway. you need to try to be more efficient about, go about, better unit economics, even if it's at the cost of, investing in innovation or growth, especially growth. So if you're looking to expand into new markets or looking into expanding to new user segments, the things that are going to involve a heavy investing on your end, on the company's end, don't do it at the expense of your runway. Not now. It's not going to be attractive to investors. It's going to be risky to your company. I know that that's what, at least I know that that's what I want. It's not the time. And there's times for expansion, and there's times for being mindful of the profitability or the unit economics of your business, and this is the latter. So yeah, that's I guess echoing what you just said, but from our point of view, that those would be important things I'd say.
Okay. Yeah, definitely 2023 was very hard, and I heard a lot at the beginning of 2023 that it was just a matter of that year, and that everyone was waiting for 2024 because everything would be back to what it was in 2021 and 2022, and it hasn't happened. So 2024 came, and of course, from one day to another, what we have is the same. Nothing changed. Maybe perspectives, maybe you see some more options in the second half of the year, but it is still tough to close rounds. So tendencies for 2024. So I think that we mentioned this like light, but it's important that the mindset has changed, and you have to focus a lot on having a healthy and sustainable growth. VCs are not going to value that much. Of course, if you have a business that does this with zero cost, it is amazing, but that doesn't happen in real life. So you need to have a sustainable, good pace growth that you can arguably defend while you're having those growth rates. And it doesn't matter if you don't have a 4x, if you have a 1.7x, but with a healthy business model, that is quite valid. So don't think that if you don't achieve greatness in year one, you're done. Of course not. Building a business takes a lot of time, okay? Then efficiency, every euro counts. So you have to really look into where it's gonna add more value to your business. And it takes time to analyze. We as CFOs are constantly doing this. Our job is to understand what are the areas where the company has to put their money, okay? If my company is losing a lot of clients, then I don't have to invest money in acquisition. I have to invest money in retention. If I have a sustainable business model that is able to keep all of my clients, then it means that I have a solid product, meaning that I can go out there and invest in marketing and sales to acquire new clients, okay? If the sales team that I have is not getting the leads or deals that I should, and my CAC is too high, we'll speak later about KPIs, just to give you a hint, then there's something we have to do there. Or we have to fire some people, or we have to cut our cost in marketing, or maybe it's a mistake in the process, but we have to decrease the acquisition cost from our sales efforts, okay? Path to profitability. This is something that I had never heard before. Like 1 year ago, no one spoke about this, and now everyone is speaking about achieving profitability. At least you have to present a business plan and a financial model where there is the option of achieving profitability as a business. Of course, if you're looking for a round, it means that you're going to have a cash inflow. That means that you're going to have losses in the near future. But at some point, you have to be able to show to VCs that your unit economics are healthy enough to achieve profitability without further investments, okay? And this is something that changes a lot mindset, because before it was, how do I spend my 6 million round that I'm gonna raise now? Then I'm gonna raise 15 million, then I'm gonna raise 40, and I have always a business plan that loses money, and my cash goes up, I consume it, goes up, I consume it. Now, it is different. You just have to show a forecast that burns money for the next 12 to 18 months. And after that, you have to be able to make the company profitable. And it is super hard because in a company that has been burning money and having losses for 5-6 years in a row, it is super hard to achieve profitability. There are actions you can take because you're not going to develop further features, for example, in your product. So there is no need to hire more R&D team, or you can even cut costs in R&D, but achieving the shift is super hard. I have seen it in very, very few startups that revenues are able to fund the operations. Okay. Hard to raise funds. As we said, the tendency from 2023 hasn't stopped yet. 2024 is still hard. At least the first half is similar dynamic. Let's see what happens in the second half. But for sure, it is not going to be suddenly as easy or with the crazy valuations we saw 2 years ago. Okay, so still keep your money and try to go for alternative financing. So out there, you can find a lot of money that comes from public authorities, both in terms of loans or grants, tax incentives. Of course, it depends on what country you're based on, but you will find a lot everywhere. Bank loans, alternative financing providers, or venture debt. Be careful with venture debt because it is super tricky. Conditions can be quite hard, but it is the only thing, in my opinion, that can replace a financing round with VCs because of the amount you can get. Of course, a bank is not going to give you 2 million if you have 300K revenue. That is not going to happen. But they can support your business a bit, and you can extend your runway so you can negotiate better conditions with VCs, or you can have more time to achieve better revenue figures. Okay.
If you don't mind, Hui, if you go about just one step back.
Yeah.
Out of this whole thing, what I would say is, that final line, like I would summarize this whole deck as cash is key. And you're gonna have to make some tough calls. For us, in all honesty, what put the company in such a Bankuish is currently in a comfortable position, thanks to building a path to profitability that was not anywhere in our sights at Q1 of 2023. But we realized the ecosystem was tough for investing, and we were heavily we had very big innovation teams, but we decided that in Q1 of 2023 we decided to hack to severely downgrade the size of our sales team and our marketing team. This was not fun. These were amazing people. They did nothing wrong. They were great. We just were not looking to grow at all costs because we realized that we had to figure out a way to lower burn, to be able to weather an unknown length of time while the VC ecosystem got their shit together. And that put us into a path where unexpectedly we achieved break even in our main market, in our largest market, soon after in that year, and we started to get positions where we could lean on to keep on growing in other areas. And that was key. So it's going to be tough. It's not going to be fun firing people that have done nothing wrong, that have been great, but that no longer fit the strategy of the company. But make those calls, because do not expand at the cost of runway in this ecosystem until you're starting to see some greener signs, but until they're very clear, don't do it. It's going to be tougher to have to close the company than it is to have to fire some people that no longer make sense in the new strategy of the company.
Yeah, my next slide was just a visual on what has happened in terms of investment and funds deployment and what is expected to happen in 2024. So same tendency, not the craziness we lived in the big days. Maybe Jose, you can give us more insights on the funding plans that you have at Bankuish and how you see the the future of the company?
Yeah, so we have this urgency in the company to grow our solution, and there's 3 lines of expansion, right? We want to expand all the kinds of financial products that we offer. So we currently are, very hedged into personal loans and vehicle financing and asset-backed loans, but we want to be able to expand, credit cards and insurance and savings and investment and pensions and so many products that we currently don't have. So there's that expansion. Then there's the expansion, the geographic expansion, right? We have pilots currently happening now in the US and in different places in the Americas that are very big projects for us. And finally, there's the user base expansion, right? We're the majority of our user base are drivers or couriers or freelancers, but we have this creator economy that we want to serve. We have these people that are developing different AI agents that we want to serve. We have all these different types of users that we want to expand into with the same solution. So for that, we're going to need money. There's no way that we can grow organically in the current ecosystem in a way that can finance that kind of growth, that kind of explosive growth. So we know that we're going to want to fund ourselves through VC. So our plan that seems to be working so far has been 2023 and until the first, until June, July, maybe August of this year. The idea is to focus on execution, right? That's a good year and a half focusing on execution, trying to get really cool metrics, but also trying to just honestly being forced to look into our numbers and be like, okay, are we making money on these products? Are we making money? Do we have positive unit economics on these features? And throw away those that just don't make sense and that we've kind of like tried to make it work by just throwing money at them, and it's no longer viable. So it was refreshing to be able to just focus on our own metrics instead of, I don't know about you guys, but what I've been doing many times before in the wonderful VC blooming years was I would think about what I would pitch to investors, reverse engineer how to get there. And that's what I would work with my team on, is try to get those KPIs that I hope I'm going to be able to show investors in 6 months or 7 months or whatever, and just focus on those KPIs. I no longer do that. I'm liberated from that because now what I really want to do is I want to make sure that the company has a healthy financial situation where we're making more money than we're losing, and we're investing, but have a deadline for making those investments scalable and profitable, and that is refreshing. Suddenly you can just focus on making your business work. But the idea is to do that, and then in 6 months or so, raise our heads, see where the market is, and decide if we want to do that funding round to be able to expand in those 3 different dimensions of growth that I explained earlier, because right now those 3 dimensions of growth are severely impacted. We can't grow in those areas. They're investment heavy. They need money. They need people. So we can't do that. We have to do a very good job with what we have right now, make money with it, hopefully have some really cool KPIs to show later, and then go and see where the VC ecosystem is, because you need 2 things here. You need to have a business that is doing well, and you need the VC ecosystem to be in a good position, because, and this is very important, even if VCs are starting to invest now, they're being super aggressive on their terms. Their valuations, the valuations that they offer are horrible. And when you're in a situation like we are, where we had very big valuations early on, you don't want a down round. You don't want to give the optics of, okay, now I'm raising at a lower valuation. So the best thing you can do is not need the money now. So try to not need the money now. Try to focus on getting your business, into a more mature situation, just focusing on the business for as long as you can. Again, everyone has different runways. And then go and see if with a better VC ecosystem, you can go and push for better terms, because, and again, going back to that slide, cash is key. And if you have to raise, you'll have to raise, and whatever valuation that is, that, you'll need to, that is your job as founder, as CEO, as whatever leader of your company. Your only job is to make sure that the lights stay on. So cash is going to have to come first. But if for as long as you can, if you can just focus on having better execution, that is what's going to be first. That's going to save your company from needing more money early on, and and then it's as Juli was saying, that's what they want. Investors now want that. They want a mature, leadership that cares about unit economics, that cares about profitability, that cares about EBITDA, and that was not the case. And to be very clear, it's not your fault. Like, they changed the rules of the game, and now we just have to adapt.
It is good to hear that you have a business that allows you to not fundraise in urgency. I mean, we see companies that suffer a lot and that they need to fundraise at any cost. They have to accept very bad valuations because if not, they're gonna die. But I guess that even so, you're still, CEOs are always speaking to VCs just to taste the waters, no? So what do you see in the, not asking maybe strictly from Bankuish, but what is your feeling with VCs as of now? What do you need to be able to demonstrate on what is gonna give you the key to getting money from them?
Yeah. So yeah, as you're saying, I'm always having, conversations with VCs. It's important just to have those relationships. I also believe in having a relationship with a VC instead of just having a 2-week, 3-week due diligence rush and then having, the investment happen or not. This is my philosophy. I think that VC should bring more than just a check. So I like to understand what they do and what their expertise is and what doors they can open. So I still have those conversations. I try to make sure that it never gets to more than 20% of my week. So if I'm already having several calls with investors that week, I'll push the other calls to other weeks. But as I do that, I'm noticing several things. One is that they're activating. Okay, they're reaching out. They're suddenly investors that didn't know, they didn't have time for me are sending emails to be like, oh, so how are things going? I heard about you in such and such conversation. And that shows, and these are partners, so that shows that they're back to wanting to understand where the market is at and seeing where they put their money. So it is waking up, but there is an imbalance. I mean, there was an imbalance earlier in 2022. Now the imbalance has inverted, and it's very heavily on the investor side. So they're showing they're taking a lot longer to do their due diligence. A lot longer. So Hui was saying that it's going from 6 to 9. I'd say that's a scary thought, right? Needing 9 months to fundraise is bananas, right? It's just, how do you budget? How do you plan for 9 months of fundraising? But that is what it's looking like. And so many things change, right? We live 7 lives in 9 months as founders. But that's the reality. So one is they take their good time, they're very picky, and the terms are one-sided because they can. Because a lot of companies, as Hui was saying, a lot of companies need the cash, so they're willing to accept worse terms, which puts them in a position of strength. So those are all things that you need to bear in mind. There's more activity, that dry powder. One thing that everyone needs to understand, dry powder is a thing, right? So investors, their job is to invest, and they receive money, and they normally have about 4 years to put that money into things that are going to give returns. And a lot of the money that they raised during the 2021, like it's expiring. They need to either invest the money or return the money, and nothing looks worse for an investment fund than returning money that they raised for their investment fund. So they're going to want to, a lot of them are in a rush to invest this money, but they have a lot of choice. A lot of startups are in a position of in a struggling position, and they're willing to accept worse terms. And again, as I told you guys, like, cash comes first. So if you need to accept bad terms to keep the lights on, then that's just what you have to do. But that obviously makes it worse for everyone else, because you're accepting worse terms, which creates a precedent and gives options to investors. So yeah, that's the current situation.
Yeah, what I feel is that with the dry powder thing, startups should be waiting like this, like, okay, there's gonna come a time when they have to deploy all the funds, because it has to happen. As you said, they're not gonna return it to LPs. It would be a very bad signal, and it would make it very hard for VCs to raise their next fund, because, I mean, what reason do I have as an LP to give you more money if you're giving me back mine? You're not doing the capital calls. So I would rather look into other assets or other VCs, at least inside the venture capital world. But it has been
I'll
more
say
than 1 year, and they are not investing it. So, I mean, of course, you see, if you have AI in your name, maybe you raise funds. If you don't, let's see what happens. But that money is going to be invested at some point. Thing is that I think that tendencies in the market affect a lot to the proper dynamics. So as everyone is saying that it is hard to raise funds, then VCs are cautious and say, okay, I can squeeze a bit in valuations because I know that they are afraid of the situation. But they are also in that sense of urgency that it's super unbalanced, because the startup has the feeling that I'm running out of cash and I need to raise, and the VC is feeling I'm full of cash and I have to deploy. So, I mean, it could exist a perfect match, but it is not happening. And this is frustrating, I understand, for entrepreneurs, but it is the reality that I see out there. And when I speak with VCs, I feel like they say, I'm not finding the exact opportunity because it is not the right moment. Well, I mean, there are huge opportunities out there. We see a lot of the startups, and we see amazing projects that could totally raise funds in any other time of the VC startups history.
I agree. I'll add that the best thing that can happen, like the most optimistic scenario here, is that you get to know, you get to have a rapport, a relationship with a fund that is running out of time, and you tell them you don't need the money, and they offer you, and this is happening to some founders that I know, and some investors have hinted that to us as well, is we would be happy to do an investment outside of a round. And that's kind of like the best case scenario for you, because you get to be the one in power. They know that they want to invest that money. They might not want to help you build a whole round, but they might do a convertible note at the valuation at a better valuation. They might do they might want to do an investment outside of a round just to deploy the capital. That's the best case scenario you have in this situation, is that you're not raising, you tell them you're not raising, but to build a relationship with a fund as well positioned as yours, to be able to have you interested in the next round, to be able to have you start showing your potential and start opening doors for the company, you are willing to accept a check from the company now outside of a round. And that's happening. So that's, if you are able to do that, and again, that takes a lot of guts, because you have to say, I don't need the money, but to build this relationship, to give you a chance to show me that you can open doors and you can add value to the mission of the company's mission, and to put you in a position to want to lead the next round, then sure, I'll take a check. And it's not easy, but it's happening.
Maybe we can go a bit into the main KPIs, and I mean, from our side, this is what we use to measure the health of the business that we work with. And I think that from your side, you can tell us, like, what are VCs really looking for? So, of course, ARR growth is quite straightforward. Net retention, it applies only to SaaS businesses, but you could apply this sense to any recurrent business, not just SaaS. And this is how much am I able to generate with my existing clients. So if I forgot about new clients and I never get new ones, will my business die or not? And to me, the most important feedback I can give a startup is focus always on retention. If it is not working, it is not the moment to spend money and invest in the go-to-market strategy. Okay, so try to keep happy the customers that you have, because that is what is going to give you a product that allows you to kill it out there. Lifetime value, of course, is the key, and especially how does your lifetime value against your CAC look like? So the money that a client brings to you, so reducing it reducing everything to the unit economics, the money that a client is bringing to you, is it more than what it costs you to acquire that client? Because if not, there is something that is not working in your business, and it is never gonna be a healthy business. So what, as a VC, why am I gonna invest money in something that returns me even less than what I'm putting in? Forgetting about all the structural costs, fixed costs, forget about them. But try first to make it a healthy business in terms of unit economics, and then you can focus on making the company profitable. But first, a client itself has to be profitable.
I will say that there's a huge difference between raising pre-seed or seed and starting to go into the Series A or Series B when it comes to financial information, right? Having a proper data room with proper financial data, proper financial statements, the jump is big. Don't make my mistake. I'm always happy to share mistakes, because if it can save you mistakes, then it will be worth it. Don't make my mistake and go unprepared. If you go unprepared to big funds that know what they're doing, they're going to make some hard questions, and that when they start talking to you about the ARR maturity and the LTV times CAC, relationship, and you blank out. You don't have a way. You don't understand, because you don't know. Like I was in that situation where it's like, so what's your CAC LTV ratio? And I literally did not know what that meant. That's not acceptable. And it shows. And again, it's all about relationships. If you look like an income poop in front of a partner of an important fund, they're just going to think this guy hasn't got his shit together. I can't put my money there. And that's very important. So just realize that you need to be ready when it comes to financial documents. That's kind of like the relationship that we have with the startup CFO, is they came to kind of like clean house, because we had been just doing our job and innovating and working on technology and working on the KPIs that we cared about, and we were not looking into these financial metrics as much, because they didn't used to matter. Now they matter a lot. Make sure you're on top of them. Look out for help. If you don't be looking, asking ChatGPT what ARPA is, on a meeting with an investor. It's not going to go well. So that's a big warning that I have. I also just want to add to Mauricio. I read your question. It's hard, man. When Mauricio is asking, do you look for investors that have the same thesis as you? And like, that's beautiful. Yeah, that'd be great. And it's a trickier thing when you say they have portfolio companies that you could have synergies with for a future merger M&A. I mean, if that's your exit strategy, sure. Otherwise, I wouldn't be attracted to that. I want to take this as far as possible, but it's not. It doesn't work like that. We're living in a world when fundraising. We live in a world of asymmetric information. VCs have a lot more information on the market and your competitive landscape than you do. They have a lot more information on other startups than you do. They are sitting down for pitches like yours for a ton of other founders. So they have a lot more information than you do. They work. This is their job. You have to do 30,000 million things. So this is not your job. So and in the end, you say, is it all about relationships? In the end, it kind of is. Like if you reach a top VC fund, and you reach with an intro from someone, from a portfolio company founder, they're going to look at you in different eyes than if you just cold email them. It sucks. It's really unfair. It does really give an edge to the social butterflies. They go to all those freaking events. I don't know how these guys have time to just go to all of those network events with funds in San Francisco, and they're in New York the other day, and then they're somewhere else the next day. I don't know how they do that and actually do their jobs, but it is important to have a minimum of relationship with these people. And also, when you want to look into having a conversation with a fund, I always use Crunchbase as your friend. I have I've had a paid subscription with Crunchbase for a long time. You look into the fund, you see what investments they have. You try to see if those portfolio companies have investors that you have in your cap table to ask for an intro, or there's a founder that you know. But having intros is important. Having relations is important. I would say that that's more important than having an aligned thesis, because funds try to be super, beautiful with their thesis, but they want to return on their investment over anything else. and it's tough. It's tough to show that value without having a rapport in the end. It's all about relationships and people. Back to you.
Yeah,
I'm sorry.
I think it's quite to what you say, and this is and I would like to really highlight a couple of things you mentioned, José, regarding these all the services coming from Santander X100 for this 2024. We are gonna try to include, you know, investors and to make you customize intros in the case you are looking for like for funding. So this is one piece of the services we are gonna really try to push during this 2024. Okay, so we want to really be like a kind of door opener, we could say, for all this kind of players, BCs, business angels, and all this ecosystem, as well as some clients and corporate venture clients as well. But I think it's quite as well important to have some specialized experts in the field and to have some help. So that's why maybe two of the benefits we have included. Well, one of the benefits we had from last year, the Santander X100 acceleration program, which is quite review process with really startup friendly experts really working on field. I think it's quite powerful, as well as the mentoring hours we are gonna launch during next April. That is gonna be more or less same format, full of mentors coming from different areas in order to help you. I think it's going to be as well quite powerful for you in order to try to solve at least these kind of small pain points in order to focus really on which is the business and on what gives you money for all the rest of the activities you are related, right? So yeah, I think it's definitely really interesting. I don't know if you have more information, Ruby. We can continue, or if not, we can change the other slots just for the people to make you the questions live, because I'm sure it would be a lot of questions that it would be maybe more interesting for them to join us as some other participants within the conversation.
Alejandro, tell us.
Yeah, first off, thank you very much for the presentation. Very useful, very interesting information. Currently, we are in a fundraising process, so we take some tips from you guys that are very useful for us. The data that you showed to us, but I have a specific question in terms of the KPIs. The issue that we are facing is that how we can calculate the churn rate as our service. Just to clarify, we are selling currently we are selling SIM cards to provide connectivity to IoT devices. So it's very complex to remove the SIM cards once it's installed in the device. So for our customers, it's more complex to change the SIM card than keep it and keep the contract with us. So it means that even we have churns with some customers, we still are invoicing them month over month. So this is not a real churn because they are still our customers. So how can we calculate the churn rate in that cases where there is not clear when the customers is ending the contract with us?
Let me see if I understood it correctly. So you're still invoicing clients that are not longer using your service.
They're using our service, but they are not our client anymore. So they decide to stop working with us, but they still have some products, some SIM cards in their installed in their devices, and they cannot change it. So they have to keep the connectivity with us, and we are still invoicing them for 1 year or 2 years, the lifetime of the device.
But if they are using your service and they're paying, why would you consider them as a churn? I mean,
because they can grow as a customer, they can activate more, but they decide to stop working with us because they receive other offer from other competitor, but we cannot grow with them anymore. They are decreasing the number of active SIMs that they have in the portfolio, but currently they are not growing, but they are paying every month on a monthly basis. So my question is, should we consider a customer churn when they stop paying to us, or when they stop hiring more services to us?
I mean, this is more, I mean, there is no written rule on how you should do this. What I would recommend is those clients still bring revenue to your company, but it is no longer what you could call your recurrent business. You're not active users. So what I would say is I suggest to differentiate what revenue or MRR, call it as you want, comes from active users and what come from this kind of users. Because first of all, it's gonna let you understand how your business is going, and then VCs for sure are gonna ask you for this differentiation. So you can keep just two blocks of different revenue streamlines, differentiating them. And then when one comes from the recurrent active to the other one, it is considered a churn, and that's it. And then it kind of churns again when it stops paying. But consider it, for example, as you can have in Netflix premium accounts and startup accounts, you have the same kind of thing. You have active users and non-active users.
Okay. Okay, but so we are going to consider a churn when the customer, so we will have the active users, not active users, but then in terms of churn, how can we calculate it? So if we say to the customer, in the case that we don't consider a customer churn when they stop, when we stop invoicing them, so probably we don't have churn. So how is the perspective from a VC about that? We can explain that we have active user and non-active user, but or churn is gonna be zero by the moment.
Well, they're gonna consider churn when a client stops being active.
Like not active users, right?
Yeah.
Okay.
Although you're still invoicing, and that is a good source of money for the company, but they are not gonna consider it as a proper user. So they would consider it as churn. Because at the end, it doesn't matter if because of switching costs or whatever kind of barriers they stop. I mean, they cannot stop paying you, which is strange, but they focus on activity and they focus on people that are really interested in your product, because that is what is gonna make your business scale at the very end.
Okay, fantastic. Thank you very much for the response. I don't know if I can take the chance to ask another question.
Yeah, go ahead. We are on time, I'd say. So yeah, no problem.
Thank you very much. It's a great opportunity to have you guys here. So my next question is, we are based in Madrid, so we are moving the company, the headquarters, to Delaware. Even we're not gonna keep the company in Madrid, and we are going to open a new branch in Colombia, Mexico. We are planning to expand the business. Actually, we have most of our business in Latin America. So we are in investment round. What do you recommend to us to look for investment in Latin America, US, or Spain, keeping in mind that most of our business is in Latin America?
Jose may know a lot about this because he has this situation.
Yeah, I have ideas. So always keep your company in Delaware for investors if you're going to raise money from American investors. What I have, what the structure that at Bankuish we have is we have a holding company, a Delaware C Corp holding company in the US, and then we have entities that are wholly owned subsidiaries of the holding company. So we have a company in Mexico, a company in Brazil, and the owners of 100% of that company is the company in the US. So that an investor, when they understand that when they're putting money into the US company, they are, they're investing in all of the companies. But when we invoice in Mexico, we invoice to the Mexican company. When we pay there, we do it there. So it's that's how we do it. I don't know if that works, but I definitely would try to keep, if you're going to try to raise money from US VCs, that definitely create the Delaware.
Okay, fantastic. Thank you very much for the suggestion. I think we are in the proper way. Sometimes we consider that is a barrier for the Spanish investors, but yeah, if we keep in mind the global one, yeah. Thank you very much, guys, for your support.
Yeah, you're going to raise a lot less money from Spanish investors than American investors. It's worth the trade-off.
Thank you so much, Alejandro, for your questions.
Thank you very much.
As
Just
well,
out of
I would like
visibility,
to, yeah,
just out of visibility, Adrian, in 3
Yeah,
minutes, I'm gonna
go
have to jump. I apologize. I have to jump a little bit early. I have a client that wants to talk.
so business is always the first. So I don't know if there is more questions there from as well the rest of the participants, rest of the Santander X100 colleagues. If it is like this and you don't mind to keep being here for maybe more 10 minutes more, where we can maybe continue if there is more questions. And like this, we leave Jose to go to keep pushing on the business.
Yeah, I mean, Juvi is the smart one here, so I'm sure he's the one that's going to get all the questions. Thank you so much, Adrian. Thank you so much, Juvi. Thank you so much, guys, for your questions and for just being here. I'll talk to you later. Bye-bye.
It's a pleasure always to have you, Jose.
I can stay, so feel free to ask questions.
Yeah, Alejandro as well is waiting on the chat. As well, if you want to make any other question, just only raise your hand here, and I will let you in within the panel, or just leave the question on the chat, and we can maybe talk about it here between us. I don't know what is happening with the camera. It should let you
No, because if I click it, it says,
yeah.
No, I can.
Yeah.
No, I can.
Okay. So yeah, I see Mauricio typing. Do you want Mauricio to get in to make a question? So let me get you in. Yes, it takes us some seconds. Hello, Mauricio. Can you hear us now?
My video was off. I don't know why. I don't know why my video is off. So I'll try by microphone only. Oh, my question is that. So here, I think here in Brazil is very common. The funds try to follow the thesis. So is much more productive to find funds that have more or less understanding about. For example, in my case, I'm talking about blockchain technologies, and they use in the financial industry. So if a fund don't know a lot about that, will be very difficult to understand my business. And so my question was that. So how to where to find, because here what I have is a lot of work to try to find the funds that has a fund that has the same thesis, or the same is investing in startups in more or less the same environment. So only Crunchbase is not sufficient for. I don't know if there is other place to search for.
Yeah, I would say that there are, well, as a source as big as Crunchbase, you can have PitchBook, which is expensive, but in PitchBook you can find a huge database of VCs. And you can also follow specialists in blockchain. They don't need to be investors, and just reach out. I mean, I don't know if you have tried to reach out via LinkedIn to people expert in the matter to make some introductions or to guide you or to provide a short list, but I mean, people are willing to help. So I would suggest to just like calling or what in this case, sending out messages in LinkedIn, or if you already know VCs, they know all the VCs in the world. I mean, they're all connected. At least in the same country, they're all connected. So if you speak with the VCs you're currently having conversations, let them know that you are looking for specialized VCs, and they make a lot of introductions between them.
Oh, great. Okay. Okay.
But reaching out in LinkedIn, PitchBook, and asking generalistic VCs to provide introductions with specific ones could help.
Okay,
well,
thank you.
just in order to add some context, Mauricio, we are here, and as well the Santander X100 team is always open to give you a hand on this kind of things, especially because like the bank and is having some colleagues within the blockchain sector, so don't hesitate to reach us, to send us an email. Just for trying to look for the proper PC or proper investor, and just for trying to help you in your specific case. That I think it's going to be much easier with a short call between both of us. Okay.
Okay, thank you so much.
Thank you. So I don't know if anyone would like to make another quick question, another 5 minutes left. Please raise your hand if you wanna make it, and this could be the last question to make to Hubi as well. I'm gonna leave you here on the chat the link of the forum. It is feature we have included within the Santander X100 platform for you to talk about all the to leave there some questions maybe about the talk, to chat between you about this topic. We think it could be sometimes quite helpful as well, because of being just focused on one sector, or in this case one topic, instead of just posting on the live feed. So as well, have a look on it, and as said, it could be maybe interesting for all of you. I don't know if there is more questions from any of you. From my point of view, and just to close this session, I think it is true this 2024, and I don't know how you see it, we looks as a maybe better year for raising some funds than the previous year, and especially than the 2024. Sometimes we try to really focus on this small market, regarding the small cap, the startups ecosystem, but it is, I think, similar trend if we talk about corporations and the stock market. Like the market really recovering after one quite tough year, and in this case, maybe with more volatility, this trend is gonna go in the same way as it goes in the stock market, maybe with some as well differences between sectors. We have been talking about maybe the AI sector is quite really trendy right now, or I don't know. I think it can be similar than if we talk about the stock market, because like as Jose was saying, from my point of view, the optimal thing is raise funds in order for you to keep working and deploying all the activities you want to do, instead of just only thinking about valuations and next round and so on, because it's at the same time happening on the corporate stock market for big technological companies and so on, now increasing their weights. But 1 year before, it was quite not the same or similar situation, right?
Yeah, I mean, it is expected to be a hard year as it was 2023. I think that by the end of maybe Q3 or Q4, it has to change. I mean, it is a huge ecosystem as of now, and of course it has ups and downs as any kind of market or economy. But it will start to grow again. So I think that what happened was just a correction, what we saw in 2023, because the levels that happened 2 years before were absolutely crazy. So
Yeah.
we won't get back to those levels, and we have to assume that that was not reasonable.
Yeah, well, definitely a bubble, wasn't it? So it's not really comparable to just talk about the difference between, or at least from my point of view, 2021 versus the 2023 or not 2022, because of being really a hard year. But I think it really goes positively on this trend. But yeah, the problem is for us to be just only thinking about 2021, where at the same time the stock market was really growing, not really in a sense way. So
yeah, so I think that we got this. We thought it was gonna stay. It crashed. Now we're just gonna achieve the healthy level that will be somewhere in between what we have seen in the last 3 years.
Yeah, especially I think it changed a bit, maybe the fact that Jose was saying about making or trying at least to make your business profitable by the beginning. This is one thing I think we all know from this. You mentioned it by like a crash, but it was really like it was. So yeah, I think we really learned about it, but the business sector will still increasing, because the trend is quite positive to look or to find some opportunities within it. So I as well for you, the Santander X100 members, like to push you to be in contact with people or experts, like the people from the startup CFO, because they are really in contact with all these pieces in their daily basis. So yeah, I think it's really interesting what Jose said, saying that you really have to focus on business development, on trying to improve your software, your business itself, and trying to have some help from very specialized people on this, on other sectors. And as well, I think have a look on all the benefits we are gonna launch during this 2024, because I think it will really help you on trying to boost your startup for the next year at least. Okay. So yeah, it is time for 11. I would really like to as well thank you, Hui, for this half an hour chat. It is always a pleasure to have you here. As said, we will leave you all the video on the slides there we'll upload it within the Santander X100 platform. And as said, we keep in contact for all and for everything you need. And it was really a pleasure. Okay, have a good afternoon there in Europe, on a good morning maybe in some places there in Latin America and North America. Okay, big hug here from Spain.
Same here. Have a nice day, guys. Thanks a lot.
Bye bye.